Alright, bet. Welcome to part 4 of the Inception model. I hope you're doing well while watching this video. Today we're going to be taking a look at ranges and the importance they play in relation to the model and how an edge can be extracted out of it. So, what is a range? So, a range is established in price after the formation of a respective swing high and swing low. So the range is the distance between the respective swing high and swing low. Footnote on the bottom right, simply just stating the fact that there are different types of ranges, which we will be taking a look at during the course of this video, but certain types of ranges do not require the formation of a swing high and swing low. So taking a look at a range, this schematic being a bearish range. So you have your swing high and then you have your swing low. In between these 2 points is the range as highlighted with the red box. And as we know from part 3 of the series, PD arrays are going to present themselves within this range. And then here would be a representation of a bullish range. So you have your swing low and then you have your swing high. In between these 2 points would be the range as highlighted with the red box. In relation to a swing high and what it looks like, it is a 3 candle formation, candle 2 being the swing high. So the respective high of candle 2 should be higher than the respective high of candle 1 and 3. So if we're paying attention to the schematic right here, we have this candle being labeled as the swing high. And the candle to the left being candle 1, we can observe the fact that its respective high is lower than candle 2's respective high. And then we have candle 3, its respective high is lower than candle 2's respective high, which is what permits for this to be a swing high. So footnote on the bottom right, simply just elaborating on that point that I just made, being candle 2 in the middle, candle 1 to the left of candle 2, and then candle 3 to the right of candle 2. And then just the complete opposite for a swing low. It is a 3 candle formation, candle 2 being the swing low. So the respective low of candle 2 should be lower than the respective candle of 1 and 3. So we have this candle being projected as a swing low. We can see that this candle's low being candle 1, its respective low is not lower than candle 2's respective low. And in candle 3, its respective low is not lower than candle 2's respective low. Before we go any deeper into the video, we should come to the acknowledgement of the importance of a range. Now, price is always going to be in a range, and knowing where you are within a given range offers a sense of clarity when engaging with price. So ranges contribute to framing a narrative, ranges aid in the gauging of order flow, and ranges can dictate how a trade is managed. So I won't touch on each one too deeply, as narrative, the gauging of order flow, and trade management each have their own dedicated part within the series. But when it comes to framing narrative, if you're looking to seek buy-side delivery, you would ideally want to be located in a discount of a given range in order to deliver into a premium of that given range, or to possibly even engage with the swing high of that given range. And then with the gauging of order flow, price action can be observed as it delivers back into the range, as signatures will be presented in price as certain levels are being engaged with. And this simply just allows for one to come to the conclusion of if price action is showing the willingness to continue delivering in their desired direction or potentially reverse on them. And then lastly, the management of a trade being dictated by a range is simply, for example, if you position yourself long in a discount of the range, you look to scale off a majority of your position once a premium of that range is engaged with, because there may be a PD array in a premium of that range that has very good reasoning to be utilized as resistance. Moving on to what we can look to do with a range. So for one, we can acknowledge a range's respective swing high and swing low. And by doing so, this allows for us to identify a premium and a discount of that given range. And then this can be taken a step further by layering out the range in quadrants. And then footnote on the bottom right, being the OTE of the range can also be identified. So we're just going to take a look at we're just going to take a look at some schematics displaying what we can do with a range. The first one being identifying a premium and a discount. So here you have your range high, your range low, equilibrium, we've now identified a premium and a discount. We know that anything above equilibrium is a premium, anything below equilibrium is a discount. And then these would be the settings in relation to the Fibonacci tool. So 1 and 0 would be your range high, range low, and then the 0.5 would be your equilibrium. And quite literally the exact same for this bullish range right here. And then quadrants of a range can automatically take an acknowledgement to the fact that it is rather similar to identifying a premium and discount of a range. The only difference is now we have identified the upper quadrant of a range as well as the lower quadrant of a range. So these would be the settings. The only difference is now we have added 0.25 and 0.75 in order to identify lower quadrant and upper quadrant. And then lastly, OTE of a range. So you have your range high, your range low, your equilibrium, and then OTE of this bearish range. So that OTE coming above the equilibrium. And then with your bullish one, range low, range high, equilibrium, OTE coming under the equilibrium. So the way you look to anchor the Fibonacci tool when it comes to identifying the OTE would be different for a bearish range and a bullish range. So in relation to a bearish range, you'd want to anchor it from the range high all the way down to the range low. And for a bullish range, you'd want to anchor it to the range low all the way up to the range high in order to identify the OTE right here. And the exact same goes for that bearish range as well. So these would be the settings, 0.705 being that OTE point. Now, if you remember with the very first slide, I stated that there are different types of ranges that we are going to be paying attention to during this video. And we look to pay attention to the likes of time-based ranges, price-based ranges, candle-based ranges, and market maker model-based ranges. And footnote on the bottom right simply stating the fact that sometimes different type-based ranges overlap with each other. And this is just simply algorithmic. And whenever I refer to price action as being algorithmic, it just means clean price action. Algorithmic price action is clean price action. And that is something to take a note of, being that algorithmic price action is clean price action. But for the remainder of this video, we're going to be taking a look at each one of these type of ranges and what they consist of, and then we're going to view some examples on the chart after in terms of identifying these different types of ranges as well as what we can look to do with these different types of ranges. So within time-based ranges consists of monthly ranges, weekly ranges, daily ranges, session ranges, hour 4 ranges, and opening ranges. These are the type of time-based ranges we look to pay attention to in relation to the Inception model. And in order for these ranges to form, a certain amount of time has to elapse for each one in order for that range to complete. So for the monthly ranges, the month of January has to elapse in order for that monthly range to be established in price. Same goes for February. The month of February is required to elapse in order for that monthly range to be established in price. And it is quite literally the exact same concepts for each and every single one of these time-based ranges. Daily ranges. Monday has to open, do whatever it pleases in order for its range to be established in price, which is why footnote on the bottom right, it exclaims the fact that time-based ranges do not require the formation of a swing high and a swing low. It simply just requires a certain amount of time to elapse, and that time is dictated by whatever range we are looking to pay attention to. So may it be a weekly range, session range, opening range, it doesn't matter. Their respective time durations need to elapse, and with each one of these time-based ranges we're paying attention to, we are paying attention to time windows that the algorithm adheres to. But moving on to price-based ranges, it consists of swing high to swing low ranges, this being the typical type of range we paid attention to during the start of the video. And then we have consolidation ranges and expansion ranges. Now, we have gone over consolidation and expansion as delivery phases on the very first part of this series. So that video should be referred back to if needs be in order to know how to identify a consolidation and an expansion. And then we have PD array ranges. So footnote on the bottom right, PD array ranges do not require the formation of a swing high and a swing low. We're just paying attention to the respective PD array. Next, we have candle-based ranges being whipsaw candle ranges, monthly candle ranges, weekly candle ranges, daily candle ranges, and hour 4 candle ranges. And we can take a notice to how candle-based ranges are relatively similar to time-based ranges. So taking a look at time-based ranges, the only thing that's missing from candle-based ranges would be session ranges and opening ranges. And then the only thing that's different with candle-based ranges is we have whipsaw candle ranges. Time-based ranges and candle-based ranges being relatively similar, this is simply because when we are observing an individual candle's range, we are simultaneously observing the interval of time that elapsed to form that candle. And this is also why candle-based ranges do not require the formation of a swing high and a swing low. Candle-based ranges require the formation of a high and low, which means that with candle-based ranges, the candle just has to go through the process it normally goes through, being an open low high close or an open high low close, in order for that candle's range to be established. Because every candle that prints on the chart, no matter what time frame you are looking at, is a respective range. 15-second candle, 5-second candle, 1 minute, 5 minute, 15 hour. It is a respective range, and it goes through the exact same principles, it goes through the exact same structure that these higher time frame candles go through in order to form. So lastly, we then have market maker model ranges. So there isn't much to this. Neither have we touched on market maker models yet. So we haven't touched on time yet. We haven't touched on market maker models. Neither have we touched on open low high close, open high low close, or power of 3. And these are very chunky parts of the model. Like I mentioned with the previous video, right now we're simply just gathering ingredients in order to be able to cook with these very chunky parts of the model that we are about to dive into. But even though we have not touched on market maker models yet, it is market maker buy model ranges and market maker sell model ranges that we pay attention to. And if you're not accustomed with market maker models, it's fine. The only thing that is required of you to know and acknowledge right now is the fact that we pay attention to the ranges of market maker models. And then footnote on the bottom right, simply just stating that from the start to finish of a market maker model is a respective range. So now we can finally jump into the charts and take a look at each one of these ranges and what we can look to do with them. So we're going to be starting with time-based ranges. So we're going to go through monthly ranges, weekly ranges, daily ranges, session ranges, hour 4 ranges, and opening ranges as well. So when it comes to time-based ranges, we are adhering to the x-axis. We are adhering to time. The start of a time-based range and the end of a time-based range is dictated by time for the type of range we are paying attention to. So if we're looking at a monthly range, the month has to open and the month has to close in order for that range to be established in price. So for example, this would be the previous month's range. You have that range high and you have that range low. So we're simply just anchoring the Fibonacci tool onto the high, down to the low. We have that equilibrium, range high, range low. And then we can take this a step further by simply layering out this range in quadrants. So here you'd have your range high, your range low, lower quadrant, equilibrium, upper quadrant. And this would be the process in relation to identifying a monthly range, a weekly range, and a daily range, as well as an hour 4 range. We can simply just jump on to the interval of time that we're looking to see as a time-based range, and then just anchor our Fibonacci tool onto it. So a weekly range, we simply just go to this week, and there is our weekly range. That is your previous week high, that is your previous week low. And these time-based ranges are very, very important when it comes to the model. When it comes to engaging with price action, it is very important to be aware of where these ranges are and where price action is around these ranges, because it's ultimately going to, well, like I was stating earlier, the importance of these ranges, it is going to contribute to framing a narrative, aid in the gauging of order flow, and it can ultimately just dictate how a trade is managed. So this would be your weekly range, and then we could drop down to that daily, and then we can see how we do it on the daily, the exact same process as well. And then that hour 4 range as well, can simply just look to anchor it on the hour 4 candle like that, or this previous hour 4 candle like this as well, all the exact same. These would be your time-based ranges. Now, the other two that we have to pay attention to would be session ranges and opening ranges. Now, we haven't touched on time yet. But we can still come to the acknowledgement that these time-based ranges should be respected. So taking a look at session ranges, simply gonna have to drop down into a 5 minute, and I'm gonna look to simply go to a random date because it was a bank holiday where I'm not going to get all of the sessions that I'm looking for here. So in relation to these time-based ranges, specifically the session ranges, we're paying attention to the likes of Asia, London, New York AM, and New York PM. So this would be your Asia range right here. And then you have your London range. This would be the beginning of London. And then we have the end. New York AM, the start, and then the end, and then you have the start of your New York PM and the end of that New York PM range. If you're watching this and you're curious as to what times these sessions are, doesn't matter. We're not paying attention to what time these sessions start, finish, none of that. What we're paying attention to is their respective ranges. They are ranges that should be paid attention to when it comes to engaging with price action and what we can look to do with them, which is the exact same that we were doing on that monthly, weekly, and daily in terms of identifying a premium and discount, as well as acknowledging their respective range high and their respective range low. So we can quite literally look to do that for each and every single session in terms of, okay, this is where, the range low is for Asia. This is where the range high is for Asia. This is where the equilibrium is, X, Y, and Z. And then we see it with London here. This is where the range high is, range low, lower quadrant, upper quadrant, equilibrium. What type of price action are we seeing at the equilibrium? We're seeing a consolidation. We're seeing consolidation here. You ask yourself, where are we seeing that consolidation? At the equilibrium of London's range, being a time-based range. After that consolidation, we end up seeing expansion. Once again, this is just like we were going over on the delivery phases video in terms of we have that consolidation, expansion, retracement, and then we can then further go into expansion again. Quite literally what we were speaking on when it came to the delivery phases video. The only difference here is now we've included elements of time. I'm trying my hardest not to go on a tangent right here, but yeah, that is quite literally it in terms of the sessions and how we can anchor the standard deviations onto them, X, Y, and Z. The next one would be opening ranges, and opening ranges would just be the first 30 minutes after the sessions open. And with New York AM, it's the only one that is different. With New York AM, we are paying attention to the 9:30 opening. Now, to be quite honest with you, there is no point in you worrying or trying to take notes or, get all of this information in your head right now, because this video is simply just based on ranges and the importance of ranges and how an edge can be extracted out of them when it comes to the model. But this would be it in relation to the session ranges and opening ranges. It's the exact same concept that we were just going over here as well. And it's pretty much going to be the exact same concept for absolutely everything we're going to take a look at. So the next one would be price-based ranges. So we're going to be taking a look at swing high to swing low ranges, consolidation ranges, expansion ranges, and PD array ranges. To be honest, I'm low-key just going to stay on this chart because it's quite literally just giving me everything I need in terms of here you have that consolidation range, and then you have that expansion range, and there's PD array ranges here, and the swing high to swing low range. So we're going to start with a swing high to swing low range in terms of what we can look to do with it. So acknowledging this price action right here, this would be a swing low, and this would be your swing high. So this would be a range low, and this would be a range high. We can see price action returning back into this range, equilibrium being very sensitive. Again, this is how we're gauging order flow. We're not seeing any body candle closure in relation to this range. And then we end up slipping into a phase of consolidation, and expansion ends up inviting itself later on. So expansion ranges, we can simply just look to anchor from this candle's low all the way up to this candle's high, deeming this our expansion range as we're looking at this 5-minute interval. Before that expansion range, we have our consolidation range being right here. So we're gonna have to jump onto a higher interval being 15 minutes to get a way better grasp of this consolidation range. But with the consolidation range, as we know, we're looking to pay attention to the bodies. So this would be that consolidation range. And we're not really looking to find the OTE of a consolidation range. Even quadrants is a little bit extra when it comes to a consolidation range. We only want to know where the equilibrium is because an order block is going to present itself at the equilibrium of that range. When it comes to expansion ranges, we can look to layer it out in quadrants as well, in terms of we can see how this upper quadrant was utilized at a certain point in time, and then we deliver back down and we see how this lower quadrant was engaged with for us to then continue that buy-side delivery motion. And then when it comes to PD array ranges, now from the PD array matrix video being part 3 of this series, we know that we are only looking to pay attention to 2 PD arrays, being a fair value gap as well as an order block. So right here we have that fair value gap right here. We can pay attention layering out in quadrants, and that's really all we're looking to do. We're not looking to layer out this FVG to find out where the OTE is. I'm actually going to look for a different segment of price action in order to display what we are talking about. But when it comes to PD array ranges, it works on absolutely any PD array. It doesn't have to only be a order block and fair value gap. It's any PD array within the matrix. And to be quite honest, I just remembered that I actually did take a trade yesterday during Asia session. And this is a very, very good example in terms of, well, what we're looking to see. So took a short position here during the Asia session, and what I executed off of would have been the 5-minute order block. This is our 5-minute change in stay in delivery. Now I took an earlier position, and this would have just been a manual candle closure, or manual closure, I'm not sure if that made sense. But I simply closed this position myself 2 candles later because I suspected that price was going to come and engage with this high again. I didn't really like the structure that was presenting itself, and I felt as though a cleaner point of inception could present itself in price. But I'm going to try and not go on a tangent about the actual trade. What we're here is to pay attention to PD array ranges. This is your order block, being that 5-minute change in stay in delivery that we executed off of. And if we're layering this order block out in quadrants, what do we take a notice to? We can take a notice to the fact that when it comes to gauging order flow, we can gauge order flow here in terms of acknowledging the fact that price action isn't displacing or closing above the mean threshold of this respective order block. The wicks are doing the damage, but the bodies are being respective, and they are telling us what we should be looking out for. Where are the wicks doing damage to? Simply the rejection block. Again, PD array matrix video. If we are to go through the PD arrays that present themselves here, this would be your old high, you have your rejection block, then you have your order block. What do we take notice to? There is no fair value gap, which is, as I mentioned in that PD array matrix video, not every PD array is going to print when a range is unraveling itself out in price. And that may be an indication as to how that range may unravel itself out in price. Because the very, very super nice setups that you see, the very, very clean point of inceptions, you're seeing a lot of PD arrays stacked up on top of each other at that point of inception. So that is what we can look to do with PD array ranges in terms of helping us gauge order flow. And we can do it with absolutely any other PD array in terms of we have this bearish fair value gap right here, no body candle closure inside of it. That is exactly what we like to see. Where does the wick go? Wicks are doing the damage. It can't even damage above the consequent encroachment of this respective fair value gap. Very nice to see. And like I just mentioned, absolutely any PD array you can look to do that with as well. And then we have candle-based ranges. Now we've basically already gone over monthly, weekly, daily, and hour 4 because we were paying attention to those when we were looking at the time-based ranges. The only one we haven't gone over would be whipsaw candle ranges. And to be honest, I might just glaze whipsaw candle ranges. I absolutely love whipsaw candles because they're very, very clear setups. In fact, the setup that I took during the Asia session was a whipsaw candle setup. Whipsaw candle setups are very, very nice setups. If you watch any of my execution analysis videos, I go on about them quite a lot. But if we are to take a look at what a whipsaw candle is first. So this candle right here, whipsaw candle. Why? The body is smaller than the wicks. The wicks are larger than the body. That is what makes this a whipsaw candle. Now, if we were to take a look at the setup that I ended up taking yesterday, this is not a trade analysis, by the way. This is simply just we're paying attention to whipsaw candles. This is a whipsaw candle right here. Why? The wicks are larger than the bodies. I was about to make this an analysis video. The wicks are larger than the body, so we can see that, this would be the range of our whipsaw candle. We can leave it in quadrants, or we can just identify the equilibrium. We're not looking to find the OTE of this range. You can end up seeing that the range high was engaged with, so the whipsaw candle high was engaged with before that whipsaw candle low was engaged with. So that would be it in relation to candle-based ranges. That is the only difference. The others would be monthly, weekly, daily, hour 4. And it's basically what we've already just gone over here when we're looking at time-based ranges. They overlap with each other because, like I was mentioning, when we are observing an individual candle, we're simultaneously observing the interval of time that elapsed to form that candle. And then lastly, we have market maker model based ranges. So we have market maker buy model ranges, market maker sell model ranges. So again, still looking at this segment of price action, I'll do this one and then I'll look to do a completely random one. So this would be a market maker sell model range right here. So this would be your market maker sell model range. And then this is your market maker buy model range right here. This would be your market maker buy model range. Now this market maker buy model is still in progress. It has not finished yet. At least I don't know. I haven't been paying attention to price action at this current point in time, but the market maker sell model is finished and we can look to do the exact same thing in terms of we can look to identify the high and the low, as well as the fact that we can look to layer this out in quadrants. You can see how price action is utilizing these quadrants once this market maker buy model starts. Market maker buy model starts on this candle right here. So all of these quadrants are relevant in price action. Lower quadrant being utilized very nicely. Order block forms right here. Equilibrium being utilized as it should be. Consolidation. Once we finally break above it, support. Upper quadrant being utilized as resistance. Return back down, deliver path under an equilibrium of that market maker sell model. Time is now invited, 9:30, deliverance up towards buy side, engaging with the original consolidation. Gone on a little bit of a tangent when it comes to market maker buy models, but like I mentioned, it does not matter if you're not accustomed with market maker buy models. For one, it has its own part of the series, and for two, this video is simply just focusing on ranges in terms of what we can look to do with them and the importance of these ranges. And with the market maker models, you can also look to find your OTE as well. So your OTE would reside here of this market maker model. Now that would be it for this example right here. Now this is something I executed off of, so one could say this is cherry picked. So we're just going to look to quite literally select a random bar, and I'm going to look for, this is actually going to require for me to look at correlated assets, but potential. This is a very clear market maker sell model. This is a point of inception. So I was literally just scanning price action to see where exactly a nice and easy. This is potential for a market maker buy model to retrace back into the market maker sell model. But we continue the market maker sell model. It's a higher time frame market maker sell model. Let's do this one. Where are we? Oh my god, 2016. Oh my goodness. Oh my, okay, I'm gonna have to drop down to a 1 minute time frame. Okay, I see a nice market maker sell model. Okay, I cannot go on to the 1 minute. We have been backdoored, to be quite honest. To be quite honest, I feel like that first example was very sufficient. This is me low-key being a little bit lazy. If I am to not be lazy and actually, strap down, this is the example I was talking about right here in terms of this is a market maker sell model. This would be a market maker sell model. Now, I'm not looking at correlated assets, so I'm not sure if the Kraken correlation has presented itself here, but when I'm observing this segment of price action, I know there's a Kraken correlation here. This is the model right here, and we deliver down into this segment of price action. This is a very clear order block, series of down close candles engaging with sell side, and then we have that expansion forming. So that is what invites for that retracement. And then we can see that if we layer it out in quadrants, we can take an acknowledgement to the fact that the equilibrium is being utilized as resistance. That's why my eye was immediately drawn to this one, but the market maker buy model would be like this. So that would be the market maker buy model. And once again, if we bring out the quadrants, we can just see how that is being utilized. We haven't touched on market maker buy models, but we can see its respectiveness here in terms of, okay, X, Y, and Z. So yeah, that would be it in terms of a, just a random date. But that would be it for the ranges. But of course, like I mentioned with that PD array matrix video, right now we're simply just dishing out the ingredients. Ingredients is all you are currently getting at this current point in time. There is no recipe in terms of do X, Y, and Z to cook the meal, But what is important to do right now is, for one, become accustomed with these tools, know how to use them efficiently, as well as become accustomed with identifying these types of ranges. Now, of course, if you're not accustomed with market maker models, it doesn't matter. Once market maker models is dropped within the series, it's going to break down absolutely everything. If you are, become accustomed with them and see how these ranges are being utilized. See how these monthly ranges, weekly, daily, session, hour 4, and the opening ranges are being utilized. Their respective highs, lows, their equilibriums, what type of price action it invites, as well as these price-based ranges. PD arrays, become accustomed with the quadrant tool in terms of layering out certain PD arrays out in quadrants and seeing how price action uses them, how efficiently it uses them. These candle-based ranges, basically in alignment with our time-based ranges, but whipsaw candles. Observe whipsaw candles. Beautiful types of setups arrive from these whipsaw candles. If you're looking at a very nice whipsaw candle setup, you're going to see if one end of it is engaged with and it's aligning with order flow, there's a clear drawn liquidity on the other side, other than the whipsaw candle respective low. Once that whipsaw candle high is engaged with, you're going to see a beautiful point of inception in terms of the PD array matrix unraveling out in price very, very nicely. Oftentimes, it's a very low resistance liquidity run as well, because the whipsaw candle will present itself and the engagement to one end of the whipsaw candle, being the high or the low, will be very, very lethargic. That is what you love to see. But yeah, that will be it for the video on ranges. Thank you for watching this video, and I'll see you in the next one.